Hello and welcome everybody. Welcome back to Sectors Made Simple. My name is Jonathan Staub, and today we are taking a look at what changed in the market in July of 2024. This was a wild month in the market with lots of changes to sector rotation, some very unexpected events with company earnings, and plenty more for us to discuss. There is so much for us to go over, so let's get straight into the action. But before we do, I need to go through the fun, and honestly, not fun at all, disclaimer. Please remember, my goal here is not to provide financial advice. It is not to tell you go buy this one company. The goal of today is to look at data that everyone has access to and show how we can use that data to try and understand the world of investments better. It is never to say buy this, don't buy that. It is strictly for educational purposes. I do a lot of research to prepare for these webinars. I share my research with you in the hopes that it gets you interested and excited about learning about the market and what happens around the market, in the hopes that you will do your own research before you make any investment decisions. Cool. Now, this is the July 2024 market review, and the goals are that we're going to take a look at a very eventful month in the market. We're going to unpack how this eventful month changed sector rotation, take a look at some of the potential reasons for these changes, figure out which sectors or types of companies came out on top, and finally, what major market and economic events might shape the market in August. So let's start off by reviewing what changed last month. If all we looked at was S&P 500 sector ETFs, looking at the performance of energy versus financials versus real estate versus industrials, it looked pretty darn good. Almost every single sector, 9 of the 11 different S&P 500 sectors recorded gains in July. However, while the overwhelming majority of sectors posted gains, the S&P 500 itself did not. The S&P 500 ETF SPY lost 0.6% over the course of the month, due almost entirely to a 7.9% loss from technology. Its ticker symbol is XLK. So if we take a closer look at the performance, this is the chart that we end up seeing. We find that, again, industrials and materials posted 4.9%. We saw a very clear trend from energy through defensive sectors such as staples, healthcare, and utilities. Then the top performers for the month were financials and real estate. On the not so great side of things, discretionary did have a fairly mixed month, but did close positive at 0.85% gain. However, the two sectors that did not return positive gains in July were communication services at a 0.6% loss, and more importantly, technology at a 7.9% loss. Because the S&P 500 is so heavily weighted towards discretionary, communication services, and technology, those sectors dragged the overall performance of the market down, causing the 0.6% loss in the S&P 500. Now, if we take a closer look at this map view from FinBiz, what we can do is take a look at where the gains and losses were concentrated within the market. As a general way we can read this, you'll see that companies are grouped based on their industry, and then those industries are grouped based on their sector. So within technology, we have software infrastructure, consumer electronics, semiconductors, and more. Then, if we look to the right, we find communication services, cyclical, which is discretionary, so on and so forth. The bigger the box for both company, but also industry, as well as the entire sector, the more value or more market cap it has within that sector. So, what we see is that the biggest boxes in this entire chart, for the most part, were negative. As we go closer to the bottom right, we go from big companies and big sectors to small companies and smaller sectors. We note that the majority of these sectors did post positive gains. And those gains were not due to one or two large companies. Instead, it was due to a market-wide shift towards these smaller sectors. Looking at the big companies, though, we find semiconductors suffered heavily throughout July. Nvidia down 16%, Broadcom down 10.6%, AMD down 14.7%, Qualcomm 16.2%, Micron 22%. Also, software infrastructure companies, Microsoft down 5.4%, and companies that operate somewhere between communications and technology, being Google and Meta, also both down heavily. So something is happening. There is something in the market that is driving negative changes for the largest, most tech or most maybe AI heavy companies in the market. And that is extremely noteworthy. And that's something we'll take a look at a lot in this webinar. But for the most part, to summarize what I briefly talked about, technology suffered heavily, largely due to companies within the software infrastructure and semiconductor industries. Across the market, it seemed like smaller companies, to call them small cap is frankly not really correct. We have to remember that even the smallest companies on that grid are still an S&P 500 company. So these are by no means small companies. They are all large cap companies. They're just not mega cap companies. But the smaller companies in the S&P 500 did perform better on average than the larger ones. And again, this difference between the biggest, smaller, and smallest companies in the entire stock market, not just the S&P 500, is something we'll dive into in today's webinar. But overall, what it seems like is that companies or sectors that are very influenced by inflation or inflation-sensitive sectors performed fairly well. These being financials and real estate. Is that to be expected? In my opinion, no. It is slightly weird that we're seeing these inflationary sensitive sectors performing well when inflation is coming down, but interest rates are still elevated. You would expect that if interest rates are high, these sectors would be doing pretty well, or when interest rates are rising, these sectors would be doing fairly well. However, we're still noting that these inflation-sensitive and interest rate-sensitive sectors are doing extremely well. And there are some good reasons for that. But additionally, industrials and materials were two standout sectors last month, not because they offered the highest returns, but because they are the sectors that we have been looking at as key drivers of this market cycle. When we see trends moving towards industrials and materials, is an indication to us that we potentially could be moving through a recessionary period into a bull market and economic recovery period. Now, let's take these couple sectors one at a time and see what has changed and what the key drivers of that change might have been. As a reminder, while we're going through this, it is impossible to look at an entire market event like financials thriving or real estate thriving and drill it down to a singular reason. We cannot say it is entirely due to this one thing or that one thing. The best we can do is say this is a key factor. So please remember that as we go through this. Now, what were the changes that drove financials what were the largest changes that led to financials being such a powerhouse throughout July of 2024? Well, typically, financials is a sector that would perform well while interest rates are rising. Reason being that they can increase their profits through this rising interest rate. However, as the interest rates cap out, the point of those interest rates being high is not to just make people suffer. The point is to put stress on the financial systems and economic systems to decrease spending, decrease new loans being opened, and that is in fact not a good thing for financials. Financials relies on new loans and new lines of credit being opened. If that isn't happening, they aren't generating as much income. So, we would expect that financials would do well while interest rates are rising, And as interest rates top out and eventually begin to decline, that is when we would see financials underperforming compared to the market. Or so sector rotation might lead us to think. But this year is a little different. In my opinion, due to the Fed's slow approach to changing federal interest rates, aka a soft landing, housing prices have remained high. This is not just my opinion. In fact, the Fed has come out and stated that rental prices and housing prices are still elevated and will likely remain elevated for years to come, meaning that we shouldn't see some immediate improvement in housing prices or rental prices. So that is a very interesting factor because traditional economic models don't account for a soft landing. This is not something that we think about because, frankly, it's never been done in the same way as the Fed is trying to do, and in my opinion, is pulling off right now. The only time the Fed has ever attempted and succeeded in a soft landing was back in the 90s. The key difference then was that inflation was already declining and they were just trying to keep it in the correct direction. So it was more of an adjustment instead of a solution. This is the first time that the Fed has tried to tackle inflation without causing a full-blown recession. And because of this, what we're seeing is that while housing prices are remaining elevated, new mortgage loans have all but stopped. There is a graph over on the Fed website from I believe the St. Louis Fed. The tool is called Fred. They offer a graph that shows us how new mortgages or new opened mortgages have changed over time. And right now is the lowest level we've ever seen throughout the 10 years that they've been collecting this data in terms of how many new mortgages have been opened. What that means is that banks aren't getting new loans. People aren't going to a bank to buy a house and open a loan, or rather not as many people are. Additionally, right now, loan delinquency is fairly low. And by that I mean since they started recording all of this data over 10 years ago, this is the lowest level we've ever seen for loan delinquency on mortgages. So what that means is that banks are still holding up. If we remember back to 2008, one of the driving reasons for the severe recession that we saw, the Great Recession in 2008, was banks failing due to offering subprime mortgage loans, or offering home loans to people that should never have gotten that loan in the first place. Whether they've learned their lesson or the Fed was better equipped to handle it now, we are finding that banks, large institutions, are not failing as much as they were in 2008, but also people aren't defaulting on their loans or their mortgages as much. That means that banks continue to have their reliable sources of income from all of these mortgages, but they're not bringing in new mortgages. So these two factors combined result in financials being in a very interesting and unprecedented place. Interest rates coming down will be a good thing. It means that people will start to put more money back into the economy, and likely we will see new mortgages start to increase once again. But in the meantime, financials is not suffering as a sector and instead is still performing extremely well because we see very low rates of defaulting on loans, which in turn continues the financial sector's ability to generate revenue and keeps them afloat. So, in my opinion, these factors combine to create a very, very strong market atmosphere for financials to do very well, even while interest rates continue to remain elevated and through the decline of interest rates in the near future. So what's going on with utilities then? Utilities, defensive sector. It's supposed to do well when no one else is. Why is utilities one of the highest returning sectors? Well, we have to go back one more month. In June, we noted that there was a lot of negative movement and bearish atmosphere for utilities, mostly surrounding energy providers and distributors such as NextEra Energy, NEE. Utilities suffered a 7% loss in June due to pullback in many of these different utilities and energy providing companies. Mostly, it's because right now money is expensive to borrow, and because money is expensive to borrow, they can't expand their infrastructure. But the rise of AI and the increasing demand for high-performance energy is driving a need that is not able to be met right now. Because of that, we saw utilities suffer. However, in July, utilities has not thrived. It has not been the new market leader. No. But they're doing okay. They are showing strong signs of growth, and while they have not reached new highs or even reached their previous May local high, they're still performing well, and they are recovering steadily. But it should be noted, the challenges that utilities faced in June have not changed. It's not suddenly that utilities found some novel way of generating energy that has allowed them to meet the demand of the market. That's going to take decades. What has changed, though, is public opinion about utilities and maybe a little bit of overreaction on the part of investors. Maybe things aren't as bad as we thought they were, and the result is that we are seeing utilities companies recover but not thrive. However, and this is the big but, right now is earnings season, which means every other day we are getting information and data for the Q2 results of energy and utilities companies. In my opinion, these earnings are going to be a make or break moment for utilities companies. Not just their Q2 results, but instead their guidance on where they expect their revenue and earnings to be throughout the rest of 2024 and into the following years. Negative guidance here could heavily punish these utilities companies that are still standing on a knife's edge. So, did utilities perform very well? Yes. Do I think that utilities is a clear leader right now? No. I think they have a lot of challenges that they need to get through, and most importantly, earnings will be a very, very clear and honest indicator of if their current valuation is accurate or if investors are overestimating or underestimating their valuations. Now, I want to talk about real estate. Two more sectors here. Real estate, XLRE. This one, frankly, is extremely, extremely easy because a lot of what we've already talked about applies to real estate as well. When we talked about financials, we talked about the importance of interest rates and how interest rates affect these sectors. For real estate, there is no better indicator of a strong recovery for real estate than lowering interest rates. So, economic events that happened throughout July gave us a lot of confidence that upcoming upcoming Fed meetings will result in some decreases in the federal funds rate, aka federal interest rates. So, because the likelihood of federal interest rate changes in 2024 have increased, real estate has enjoyed those changes. So, as we mentioned with XLF, when the interest rate drops, this is a valuable opportunity for real estate companies to be able to continue the momentum that they had prior to rate hikes. So, we're going to see continued investment into real estate projects, into development, existing real estate, mortgages, and more. Essentially, financials and real estate are loving the fact that the end of high interest rates is just around the corner. And in my opinion, is a driving reason for XLRE's success throughout July of 2024. The last sector I want to take a look at is technology. And unfortunately, unlike financials and real estate that were fairly easy to pinpoint a reason for their success, finding the reasons for failure for technology is a little bit tougher. The reason is that semiconductor companies were a major talking point throughout the past few months. I don't think I need to be here to tell you about the meteoric rise of NVIDIA and the meteoric rise of AI companies as a whole. However, in July, both presidential candidates, presidential candidates, Trump and Biden both issued separate statements or opinions surrounding the semiconductor industry, and most importantly, about their approaches to Taiwan. Trump wants to decrease our reliance and doesn't understand why we are defending Taiwan as much, and wants to decrease our reliance on Taiwan as a whole, but primarily on our reliance of Taiwanese semiconductors. The actual numbers vary depending on the complexity of the semiconductors, but for the most part, regardless of what metric you look at, Taiwan produces anywhere from 70 to 90% of the global supply of semiconductors. Because of that, they are a key part of global supply chains and are the reason that current semiconductor prices are where they are. So Trump's solution is decrease our support for Taiwan in the hopes that semiconductors magically get produced somewhere else. Biden takes a slightly different approach and instead has already passed some legislation to try and incentivize and provide additional funding for producing semiconductors here in the United States. However, that does not magically create a solution. In fact, it creates a big problem where existing supply chains are built around Taiwan being the producer of these semiconductors. If that all of a sudden changes, we are now creating new supply chains, trying to create new sources of supply, and that is a process that takes years to even set up and even more years to be able to stabilize. Because of this, because both candidates, both candidate and previous candidate, had these strong, hardline opinions about decreasing our reliance on either Taiwan or increasing our domestic production of semiconductors. Semiconductor companies, as they exist right now, suffered. Didn't matter which one you looked at. NVIDIA, Broadcom, AMD, Qualcomm, and Micron all dropped over 15% over the course of July. So what about the rest of the companies? Why did we see software infrastructure companies decline? Well, CrowdStrike. For anyone that was following the market, and honestly the world throughout July, you'll probably be familiar with the global internet outage that was caused by CrowdStrike in mid-July. This bug impacted Windows systems, and these Windows systems that were affected ranged from your personal computer all the way up to global systems that power stock markets, hospitals, banks, and even airlines. Current estimates put the damage in the mid-billions in terms of how much damage was caused, and there's still attempts to clean up the damage that was caused by this outage weeks ago. So because of that, Microsoft's stock price was heavily hit, with associated companies being damaged as well. Also, while I was working on this presentation, and honestly, while I was finishing up this presentation, we got Microsoft's earnings. Microsoft's earnings were very interesting because they beat revenue and EPS estimates, but due to poor sales from their Azure cloud services, current numbers show that Microsoft stock is down 6% after hours. At least it was down 6% when I wrote this presentation. It's currently recovered and is down 3.53% after hours. So, Microsoft is having a hard time, and semiconductor companies as a whole are reeling, trying to figure out what their next steps might be. But that's just the surface. Those are just the noteworthy sectors that there's something clear that we can point to as the driving force behind its changes. Well, let's go back to something a little bit more simple and straightforward, breakouts and breakdowns. There were no breakdowns in July. Again, the majority of sectors posted positive gains. So because of that, we can only really look at breakouts, which means companies breaking previous levels of resistance and entering new territory. We had 3 breakouts throughout July. XLE went on a double top breakout on July 17th, and then July 12th had 2 different point and figure breakouts from healthcare, XLV, on July 12th, as well as real estate on July 12th as well. Jonathan, I remember last year I asked if elections will impact the market. Do you think the upcoming month will be difficult while elections are getting closer? That is a really good question. Do elections impact the stock market? Yes. Do elections impact the stock market more than other events? No. One of the reasons why elections impact the market is that people don't like instability or don't like uncertainty. So it typically doesn't result in directional change if it's a Democrat or a Republican or an independent. Typically what we'll see is increased market volatility in and surrounding an election, and then after that, things calm down a little bit. What does make a difference is the distribution of parties between the presidency and Senate and Congress. Congress. From Senate and House of Representatives. If we see a majority for all three of those different seats, we will see the market respond. The direction, though, is unclear. The reason is because when there is a clean sweep for one party or another across all three bodies, it becomes extremely easy to pass legislation. Meaning, you can propose whatever you want, and as long as your party agrees with it, it's probably going to get through, if you are the leading party. If there is more conflict, if there isn't a unanimous party that is in control of all three bodies, then things get a little bit more tricky, because any piece of legislation that needs to get passed needs to have bipartisan support. So what ends up happening is one party proposes, I want to do this. So for example, I want to increase funding for domestic semiconductor manufacturing. That might be the goal. Then it goes to the House of Representatives, and the House of Representatives belongs to the same party that proposed the bill. No problem there. Then it goes to the Senate, and pretend the Senate is controlled by the opposite party. They're going to say, we don't like that. We don't want to just increase funding for semiconductor companies. Instead, what we want to do is we want to hurt other semiconductor companies. So we aren't incentivizing semiconductor manufacturing to come to the US. We're just hurting the other guys so that they don't want to produce as much for us. So what that might end up looking like is higher taxation, higher tariffs on importing semiconductors. That is, funny enough, the position of one of the two parties. Their position is increase the taxation and limit how much we can import semiconductors into the United States. So it ends up being a negotiation. It's not just we can propose whatever we want and get it passed. So typically, when there is a unanimous party that has control of all three bodies, presidency, Senate, and House of Representatives, investors will respond. The direction can change. But if there's mixed representation, meaning Democrats have some parties or have some of these seats, Republicans have others, typically we're not going to see anything crazy because any legislation needs to have at least some sort of collaboration across the aisle in order for it to happen. So long story short, do I think the upcoming month will be difficult? Not because of the election. I think that there's way bigger topics that are going to drive market changes beyond just the election. I think in November we're going to see some uncertainty and a little bit of panic surrounding the election, but beyond that, nothing crazy. Great question. Alrighty. So, going back to what we were talking about here, 3 different breakouts in July. Energy on the 17th, healthcare and real estate on the 12th. Now, let's take a look at how sector leadership, aka sector rotation, has changed. And for this, we're going to turn over to our matrix. Our matrix is a tool that allows us to see sector leadership for both short-term and long-term strength. We do this by comparing all the different sector ETFs to find which ones are the leaders over others. So, by looking at this, what we can see is the sectors with the highest total count strength, which is the combination of short-term and long-term, are the sectors we consider to be our leaders. Looking back on July 1st, it was pretty clear. We had communications and technology. That's it. On the bottom, because at the time, interest rates and future changes to interest rates were fairly uncertain, we found industrials, real estate, and materials. So if we overlaid that with our sector rotation chart, we would find technology, communication services, with materials, industrials, and real estate being the laggards. What this points to here is that we're sitting somewhere in a full recessionary period, moving towards an early recovery. So, this is what it looked like at the end of July. All of a sudden, technology and discretionary have fallen from the top of the matrix and are tied sector leaders to nearer to or at the bottom, joining stables. So, we noted a massive shift in sector rotation. Is this normal to see in 1 month? No, it's not. This is not normal to see in 1 month. Typically, we'll see some minor changes or 1 or 2 sectors that will shift as a result of market news unrelated to sector rotation. But this does create a little bit of a confusing picture. So instead of just plotting these leaders and laggards over the same sector rotation chart, I want to show you momentum. Because with our matrix, what we can do is we can look at how the strength has changed from one date to another. So this table shows us how the matrix has changed from July 1st to July 30th. Sometimes staring at light makes me sneeze. And I do have a massive light that's sitting above me. So, what we're talking about. We found that when we compare how strength has changed from July 1st to July 30th, this is what we get. Positive numbers indicate that it has gained strength. Negative numbers indicate that it has lost strength. Clearly, technology lost almost all of its relative strength, with communications and discretionary close behind. These 3 sectors, very tightly grouped. Meanwhile, we see utilities, industrials, and then materials, and to a lesser extent, financials and real estate. So if we now overlaid those results onto this chart, technology communication services have fallen along with discretionary, while industrials, utilities, and materials have gained strength. That is a fairly clear shift in sector rotation. Utilities, real estate, financials, we talked about why those sectors are performing well right now, despite what sector rotation might imply. Which is why I didn't highlight financials and real estate here. We've already understood why those sectors are experiencing the changes they are. But what is very important here, and those 2 sectors we didn't talk about earlier, are industrials and materials. The reason why we didn't talk about them is now we get to talk about them. Outside of utilities, sector rotation clearly seems to be moving through a recessionary stage and into an economic recovery and a bull market period. So now that I mentioned that, let's quickly look at this again. We see, if we line up where industrials and materials fall, we are in a strong bull market and an early economic recovery. What's different though? Again, financials and real estate are performing extremely well, despite what typical sector rotation would indicate. For all of the reasons that we talked about earlier. Now, let's shift gears and go from talking about sector rotation and sector ETFs to starting to look at some of the nuts and bolts behind what these changes are and, more importantly, why they're happening. So I want to take a look here at the Federal Reserve and federal interest rates. This might come as a surprise, but if you've been following our newsletters and our webinars throughout July, it should not be a surprise at all. July was extremely eventful for economic data. On July 11th, we received CPI inflation data for June. Both headline and core inflation came in under analyst estimates. Then, on July 12th, consumer sentiment came in below analyst estimates, as well as retail sales on July 16th. So we had CPI inflation pointing to economic progress. We had consumer sentiment declining, which might seem like a bad thing, but if you studied economics or some of our webinars, you'll know that declining consumer confidence or consumer sentiment is actually a good thing. If what we want to see is our economy moving out of a recession and into a period of recovery and expansion, negative consumer sentiment is a big part of that. The reason is that we want to see that consumers are feeling the pressure, that consumers are reducing how much they're spending through retail sales data, or how they feel about the economy through consumer sentiment. Seeing both of those metrics declining or remaining steady is a very good sign. Both of these coming in under analyst estimates, even better. All of these points give us one singular conclusion. The Fed's goal of a soft landing is not only still possible, it's almost likely. And it's not just me saying that. Again, I've been talking about a soft landing for months. We've been studying the economic data behind the possibility and the indicators of a soft landing for months. We've talked about why this is something they don't really attempt and how their previous attempts have gone. Guess what? We're still talking about it, and now it's not just me getting to cover it. Don't take my word for it. Take the word of Google. Whatever that means for you. That might mean a lot, that might mean nothing. Either way, Google Trends is a really cool tool. Google Trends allows us to see how the volume of search for a specific keyword has changed. Using less nerdy terms, essentially, every time you search for something, it remembers. And it adds up how many people have searched for chocolate chip cookie recipes. And it'll give you a graph to show you where the highest point on the graph is the most people searching during that period of time. Instead of just going through this slide, I actually want to go to Google Trends with you so that we can do this together. Because one, it's really fun and I encourage you to poke around this tool yourself. And two, a picture's worth 1,000 words, right? So let's go here and let's type in soft landing. And we'll go down here and specify that we want it to be economic. Because honestly, I don't know what a soft landing starship is, but I don't really think that's related to what we're looking for. What is soft landing. If we look at how the interest over time for this search has changed, again, we've been talking here at Sectors Made Simple about a soft landing for months. The amount of search has been 0 for soft landing for the past 90 days. Let's go 12 months. People started to get fairly jaded, not thinking that it was even possible. But over the past 90 days, we went from no one really talking about it to all of a sudden, people are starting to pay attention. People are starting to pay even more attention. And on July 25th, the interest in a soft landing peaked. Why? Because major news outlets started actually saying a soft landing is not only possible, but is very, very likely. And conversation around a soft landing only continues. So, what we're seeing is that more and more people, not just economists, just average Americans, are talking about and thinking about the possibility and honestly the likelihood of a soft landing. And what happened on July 25th? GDP data. The GDP data showed that the GDP is stronger than forecasted, which means not only is inflation decreasing more than estimates, not only is consumer sentiment declining and retail sales data staying in line, if not a little better than we expected, GDP remains strong, meaning our economy is still performing well. One of the oldest definitions of a recession is 2 consecutive quarters of GDP losses. Seeing our GDP continue to perform well and remain well above that positive indicator, or that positive line, is a strong indication that a soft landing is not only possible, but at this point, very likely. That is very, very, very good news. But that's not where the conversation ends. Today, July 30th, and tomorrow, July 31st, are the FOMC meetings, the first FOMC meetings of quarter 3, 2024. Right now, current forecasts show a 96% chance that the federal interest rate, or Fed fund rate, will remain the same at 5.25, 5.5%. So why does that matter? I thought that we just talked about things are looking really good, the tank is clean, everyone's really happy. They are, but it's too early to start making changes. The Fed has come out and stated that very, very clearly. They are looking for 2 things: continued progress at decreasing inflation, or an instantaneous spike in unemployment. Why? Unemployment is one of the most felt indicators of a recession, or most felt effects of a recession. It always hits home when people start losing their jobs. Feeling monetary pressure sucks. Yeah, I know. But losing your job on top of monetary pressure, that's when things get really rough. So, continuing to see people decrease their spending and getting a little bit more pessimistic about the economy is actually a good sign as long as unemployment remains low. So, in this meeting, don't expect anything crazy. The interest rates are not going to change, and frankly, the results of tomorrow's meeting will probably be pretty boring. The biggest thing we can take away from tomorrow's meeting is the press conference that Chairman Jerome Powell gives after the session. That is actually worth paying attention to see how optimistic, aka dovish, or pessimistic, aka hawkish, he seems to be. If the past data is anything to go off of, I'm expecting fairly dovish. But September, which is the next meeting, will be a little bit of a different story. Following the CPI inflation announcement on July 11th, the forecast for no rate change for the September meeting dropped to 0. Literally 0. What that means is investors and economists are completely in agreement that we will see rate changes in September. But it doesn't just stop there. When we looked at the summary of economic projections in our last session together, and I just want to pull this up so we can all get a quick refresher, the Fed expects the Fed fund rate at the end of this year to be 5% to 5.25%, meaning only one rate decrease. We're at 5.25 to 5.5. One rate decrease, which would be 0.25 basis points, would be 5 to 5.25. Forecasting has changed, though. Why? The economic data we've got in July. Current forecasts show a likelihood for the September meeting of a 0.25% decrease at 86.3%, meaning there's an 86.3% likelihood of a 0.25% decrease to the federal funds rate. But I said there was a 0% chance of no rate decrease, right? I did. And both are true. Meaning that the other 13.7% think that we will see additional rate decreases in September. That's optimistic. Not just because a 0.5% or larger decrease is fairly significant, but because the Fed's estimate is one rate decrease, seeing multiple just in September is pretty wild. But not insane. And the reason why I say that is that by the end of year forecasting, the forecasting for the final meeting of 2024 in December, there is only a 1.3% chance. The forecasts show a 1.3% chance that the interest rate is 5 to 5.25%. 98.7% of estimates expect the rate to be lower than 5%, meaning below the forecast of the Fed. That is how significant of a shift this economic data from July was. It not only provided optimism for investors and economists, but it blew forecasting out of the water, where all of a sudden we went from expecting one rate change in all of 2024 to an almost unanimous decision that we will see multiple rate decreases throughout the year. A strong indication that not only has the Fed pulled off a soft landing, but that they're doing it in style. Now, economic data is cool, but we're stock investors here. How has the stock market responded to these announcements, not by the Fed, but by these different data releases that we've gotten? Well, typically, small cap companies are the ones most heavily impacted by economic changes. They're typically the first to fall, but they're also typically the first to recover. So when we start to see rate decreases, we would expect that smaller cap companies would be the first ones to benefit from that change. So if that held true, if what I'm thinking is correct, we would expect that small cap companies did really well in July. So, did they? Find out next time. I'm kidding. Find out right now. Well, yes, they did. This graph right here is showing 4 different ETFs. An ETF for the S&P 100, being the 100 largest companies in the S&P 500. The S&P 500 itself, we all know that one. The S&P 400 Mid-Cap Index, and the S&P 600 Small Cap Index. In July, the return of the S&P 100 was a 2% loss. S&P 500, 0.6% loss. Mid-Cap, 6.2% gain. Small Cap, 11.1% gain. So, what did we find? Well, in contrast to June, where large cap companies dominated the market, in July, not only did small cap outperform the market, they thrived. Small cap companies especially did amazingly in July. They enjoyed solid gains. They were more resilient to market shifts where we saw these mega cap companies losing value. In fact, on the days where we saw Nvidia, Microsoft, Google all dropping multiple percentage points, small cap companies posted gains. One day, we saw technology drop 3%. XLK dropped 3% in a single day. That same day, the Russell 2000 small cap index rose 3%. They are outperforming the S&P 500 in a significant and massive way. And it wasn't just small cap. It is a general rule of thumb that the smaller the market cap index was, or the smaller the market cap of that company was, the stronger on average it performed. That is really big. What that seems to indicate is that weaknesses that we're seeing right now are mostly contained within large and beyond large cap, mega cap companies. The largest companies in the S&P 500 are the ones that are taking the majority of these losses. Meanwhile, current market atmosphere is really good. And we're seeing that. we are seeing these small cap, mid cap, and even some large cap companies outperforming others and posting solid gains throughout July. That's where we'll put optimism aside. I want to now talk about something that's a little bit more cautious. What is the future of AI? No, not what is the future of developing AI. I mean, what is the future of AI companies? Because right now, that's being put into question. Throughout July, we noted a significant degree of pullback in AI or AI-related companies. This was mostly contained within technology, but extended out of technology into companies such as Google and Meta over in communications as well, and even Tesla over in the discretionary sector. Last week, Google announced their earnings, and in their earnings, they beat revenue and earning estimates. If it were literally any other quarter, Google beating earnings and revenue estimates would be a great sign. Investors would celebrate it. Typically, investors reward companies that beat earnings and revenue estimates. That's just how it goes. This isn't any other quarter. Investors dug pretty deep into Google's earnings call, and in their breakdown of their revenue, they noted that Google is investing heavily into AI and is not seeing immediate results, is not seeing immediate return on that investment. Plus, Google has been investing heavily into expanding the smart features of their ads programs, primarily YouTube ads. And Q2 showed lower than expected YouTube ad sales. Because of that, Google was heavily punished. Their stock price dropped over 5% the day after this announcement. So what that means is it's not just enough to beat estimates. Right now, if you are a company that is related to AI, investors are going to be picking through your earnings results, checking to see if that investment into AI actually is showing results. And again, as a final update to this presentation, because this was all breaking news as the presentation was being wrapped up, Microsoft today met a similar fate. They beat estimates, but failed to meet expectations for their AI and Azure cloud computing services. So again, we are seeing major industry leaders, market leaders, the largest companies in the world, get heavily punished for investing heavily and doubling down on AI without showing immediate results for their efforts. So that leads to my opinion. And again, this is my opinion. I think technology companies, and honestly any company that is AI related, is going to face really harsh criticism this quarter. It will not be enough to show that you beat revenue and earnings estimates. That will not simply be enough. Instead, I think investors are really going to want to not only see the results, but also hear in earnings calls how these companies are taking AI and their investment into AI and creating real, tangible value for it. Are they making money? And we're not talking making money 2 years from now. I'm talking making money 3 months ago. AI is not new. The heavy investment into AI has been going on for years. The reason that it's gotten so much more attention right now is that generative AI has blown up over the past year or so. So it's not like all these companies were just stuck doing nothing before. These companies have been investing in AI and machine learning for years. That's been Google's whole thing, is AI models to help you search AI. Well, guess what? OpenAI right now is developing a competitor called Search AI. It is meant to compete with Google's search algorithms. That is a big competitor. It is the industry leader for developing generative AI, putting their foot and putting their hat into the ring of traditional conventional search. So these major companies need to step up. They need to start showing results, and those results need to be happening right now. And again, that doesn't just relate to AI generating companies. That extends to semiconductor companies as well. Semiconductor companies are in a very precarious spot right now, and I think that Q2 earnings and their guidance for the upcoming quarters is going to be extremely important. Right now, a lot of the value that is being thrown onto companies like NVIDIA, AMD, Qualcomm, TSM, it is a massive growth valuation. Those companies are not worth what they're trading at right now. You are buying their future performance a year, 2 years, or 3 years from now. So because of that, if all of a sudden the future outlook of demand for AI or the viability of AI or a learning cap for AI becomes realized, companies are going to be heavily punished for that. So it's really hard to say what is the correct current value and future value growth versus where are stock prices right now. And because there's no simple answer, any new news we get, positive or on the positive side of things, is going to help. But no one likes having the story be obvious. No one likes the story being uneventful. They like bad news. Bad news spreads. So because of that, I think that any sort of weakness that any of these companies show is going to be heavily punished. Things go right, everyone's happy, but nothing changes. Things go wrong, everything changes, and their stock price drops. That's what we've seen with Google. That's what we saw with Tesla. That's what we saw with Microsoft today. And likely that is what we will see for any other semiconductor companies that announce earnings and fail to meet every expectation from analysts. So that's where that's at. And unfortunately, or fortunately, depending on how you want to look at things, earnings season is just starting. And unfortunately, we don't really have enough time to dive deep into the topic of earnings today. But I do. So we do talk about earnings on a weekly basis. In our newsletters, which you can subscribe to over at sectorsmadesimple.com, they are completely free to join, and we send you a newsletter every Monday to your inbox. In each one of those newsletters, our What to Watch For section will focus on key earnings to keep your eyes on that will be occurring in that trading week. So while we don't have time to go over it today, I do recommend signing up for our newsletter. Again, it is totally free to stay up to date on what key earnings might drive market activity that week. And again, this quarter's earnings will not be as straightforward as other years or other quarters have been. We're finding that beating earnings and revenue is not enough. And at least for the mega cap companies, any signs of weakness are being punished. So I want to wrap up things today by talking about some key economic dates that we can keep our eyes on in August. August 2nd, pre-market open will be the unemployment rate for July. The PPI will be on August 13th. This is a leading indicator of inflation. Then we have CPI inflation on August 14th, both headline and core. Retail sales on the following day on August 15th. August 16th, during market hours, we will have the Michigan Consumer Sentiment data. Then on August 21st, we will receive the FOMC minutes summary for the current session, as well as we'll round things out on August 30th with the PCE, headline and core inflation. All right. July was exciting. There was a lot of good, a lot of recovery, a lot of progress, but if all you looked at was the headline price of the S&P 500 or the key biggest companies that you've probably seen, things look more dire than they really might be. It is very easy to get caught up in the performance of mega cap companies because, after all, the S&P 500 and sector ETFs are all market cap weighted. But it's very important to remember that the stock market is more than just the 5 or 7 largest companies in the world. There are hundreds and thousands of companies that make it up, And we have the option to invest in those companies just like we have the option to invest in the largest companies. This should not say that the market is weak right now. There are challenges that the market is facing, but overall, the economy is moving in the right direction, and that will serve to benefit the majority of companies. Small cap first, mid cap follows, and finally, mega cap and large cap will be last. But overall, this is a fascinating time to be studying the market. There's lots of both economic and company level activity going on, so keep your eyes peeled, stay informed, keep up to date with our socials, both our newsletter and our social media posts, to be informed on these breaking events as they happen. So thank you all so much for joining us today. It has been such a pleasure to take a look at what changed in July and what we should keep our eyes on in August. Thank you all so much. Let's see if anyone has any questions before we go. Hello, Tony. Welcome, welcome. This is the absurdity that I get up to every Tuesday. Thank you for joining. Love you, bud. Tony is my brother. So, thank you so much for joining, bud. Awesome. There are no questions, so that's where we will leave things for today. Thank you all so much for joining us. If you have any questions or want to discuss anything further, you can send us an email at support@sectorsmadesimple.com. This video will be available here on YouTube, as well as you can catch it over on our Learn site, learn.sectorsmadesimple.com. All of our webinars for both free members as well as paid subscribers are available there to watch. So thank you all so much.